let's get to price to sales ratio, enterprise value sales ratio, and this is going to go into the fundamentals with Coca-Cola as well when we get into it. Oh, so let's just get into the definitions. The price to sales ratio utilizes a company's market capitalization and revenue to determine whether the stock is valued properly. In a vacuum, the lower the PS ratio, the more attractive the investment. Price to sales provides a useful measure for sizing up stocks. The price to sales ratio, price to sales or PS, is calculated. Already did that. We usually use it the past 12 months. The price to sales ratio does not account for the debt on a company's balance sheet. A firm with no debt and a low PS metric is a more attractive investment than a firm with a high debt and the same PS. The price to sales ratio as a valuation method doesn't consider the companies with high debt levels will ultimately need higher sales to service the debt. Use enterprise value sales ratio rather than market capitalization sales. The enterprise value includes a company's long-term debt into the process of valuing the stock. By adding the company's long-term debt to the company's market capitalization and subtracting any cash, one arrives at the company's enterprise value. Think of enterprise value as the total cost of buying the company, including its debt and leftover cash. So that's where the difference between price to sales and enterprise value to sales lies. With enterprise value to sales, it includes the debt the company has as well. All right. So say if the price to sales, we'll say if the market capitalization is $20 million, right? But they have $20 million in additional debt. That means the enterprise value is $40 million. So that's what it takes to buy out the company with the debt. And here, just over here, are some of the average PS ratios of the industries. And we'll get into the drink beverage industry and their averages as well. But you see managed healthcare, 16, real estate, 11.49 down here. Medical dental instruments, about a 10. Computer software, about a 10. This is for price to sales. EV sales, better than price to sales, 303 English ordinal. Used EV sales in drink industry, 2022 English Sumerian. So something to think about. And again, it works really well with beverage companies, what we're going to get into. The beverage company comparison, price to sales, EV sales. And obviously, one of the biggest companies I'm invested in is LTNC Locked In, and it's a hydrogen water company. So I want to look at the landscape and competitors for Coke, Monster, Pepsi, Celsius, Dr. Pepper, Keurig. And so these are the price to sales and the enterprise value sales for each. So we have Coca-Cola, KO. Their price to sales is 5.23. That's not too bad. Their market capper, so that's not bad. Then their enterprise value to sales is 5.79. You have Monster, and you have to understand for smaller companies like Monster and Celsius, their price to sales are going to be higher because their sales aren't that big yet, and they have higher prices. They're overvalued. Okay, so for Monster, their price to sales is 7.92, and their enterprise value for sales is 7.33. So you see it's a little bit higher than Coca-Cola's. Coca-Cola has higher sales. It's closer to its market capitalization. Monster, it's more overvalued. Then you have Pepsi, which is more fairly valued at 2.49, and its EV for sales is 2.86. So say if you compare Coca-Cola and Pepsi in this case, you say, oh, well, if you use price to sales, EV to sales as a valuator, Pepsi is a better value than Coca-Cola. You could say that, or you could say, Coca-Cola is a little bit more overvalued because people like it more, and stuff. Then you have Celsius. So they have a price to sales of 12.3. And then you have the EV sales of 12.6. Again, it's really high because it's a younger company. It's way overvalued. The sales don't match that, right? And then you have Keurig Dr. Pepper, price sales 2.93, and their EV sales is 3.84. So it seems like they might have a little debt on hand. And so when you look at the difference between the big boys, KO, Coke, Pepsi, Keurig Dr. Pepper, to the smaller, younger companies, Monster, Celsius. All right, Monster's a little bit older than Celsius. That's why it has a little bit less price to sales. Um, and so that's just very interesting. And then you see at the bottom, look at the average price to sales for in the beverage production distribution world. It's 8.52. So it's kind of in line, right? If you think about it, 8.5 is kind of in line what we're seeing right here for the big boys right here. You know, you have the outliers of Celsius at 12, almost 13. You have Monster at almost 8. Then you have Pepsi and Dr. Pepper at 2, 3. Then you have Coca-Cola in the middle. So that's kind of in line. That's good to see. Enterprise value sales is a reliable ratio for beverage business comparisons. 3,033 in the Fibonacci. I think that's in a very important decode. It's in the Fibonacci cipher. It's the growth cipher, and I've been using it with money as well. So enterprise value sales is reliable ratio for beverage business comparisons. 3,033 in Fibonacci. I think that's very powerful. And we'll this goes with Coca-Cola as well.